So you're looking to buy a house, but you're not sure how much you can afford. And sure, you've been thinking of going to see a broker just like me, but the thought of having to do that is annoying. And I can't blame you, it takes time, plus you don't really want to feel pressure to actually do anything about your meeting. You just sort of want to know. Well, in this video, we're going to look at a very simple way for you to determine your own borrowing capacity on your own using simple grade school math and a little bit of logic. And as a bonus, it's going to help you guys understand a new rule coming to Canada regarding something called the loan to income ratio and what sort of impact that's going to have on the market. So let's dive in. Hi, my name is David Pons and I'm your friendly neighborhood mortgage broker from Montreal, Quebec. On these videos, we explore mortgages and all their quirks and features, and we also learn a little bit about finance and credit. If you never want to miss any of these fascinating videos, make sure to like, subscribe, and most importantly, hit that bell icon so you get notified when I post. Now, the whole idea behind this method is based on the principle that the maximum amount of money a bank will lend you in a mortgage depends on your income. And of course, you already knew that. But what you may not realize is that this means that there's a simple way for you to determine your own capacity just by multiplying your admissible income by a certain factor that we're going to determine together in this video. Now, please note that I said admissible income, and that's a big issue because sometimes we don't make the kind of money we think we make, at least not in the eyes of the banks. Please see my video on this right here. But just keep in mind, there's all kinds of rules to follow when it comes to proving your income. And if your income is variable, recent, unstable, hard to determine in any way, this whole thing might not work. So take it all with a proverbial grain of salt. That said, if you do know for sure what your income is, then this is how it works. You have two options, either insured or not. The math will be different. Now, when I say insured, I don't mean home insurance. I mean mortgage insurance, which you have to get when you put less than 20% as a down payment. I'm going to make a video on this later and I'm going to link it down below, but still, here's the first question to ask yourself. Can I put 20% down or not? Well, let's look at the scenario where you can't, where you just put 5% down. This means you have to follow the debt servicing ratios of the CMHC or the other two insurers in Canada and limit yourself to 39% TDSR. Never you mind for now what that means. I don't want to get lost in the weeds. A very rough income multiple to consider is the number 4. 4 in this example is your loan to income ratio. Remember this. This means that you take your admissible income and you multiply it by 4, and that will give you your maximum loan amount. Now, how do you get to the house price? Well, if you put only 5% down, that loan will represent 98.8% of the purchase price because you're adding that CMHC insurance premium back into the loan. So basically, the loan is almost the same as the purchase price when you put 5% down. This means that just by multiplying your income by 4, in this case, you get a rough estimate of what kind of home you can buy. You're making $100,000 a year? That's right, that's a $400,000 purchase. Now, please know the word rough and also know that this particular multiple only works right now in April 2024 with today's insured rates around 5%. It also only works if you have very little other debt like balances on your credit cards or car loans. If you do, forget the 4. Okay, so now what happens if you do have 20% to give as a down payment? Well, your capacity can increase because there are banks out there that are able to go all the way to 60% TDSR versus the 39% from before. Of course, the rates are going to be higher because these are riskier loans, but if you really want that bigger house, you can get it. The multiple to use this time is 5.5. The loan to income ratio is 5.5 here. This means that the same client that was making $100,000 can now qualify for a $550,000 loan. But in this case, it's also not the purchase price because there's no insurance premium and that's a chunky 20% down payment. So if you add the down payment back in, you can actually buy a $687,500 home. How did I get that number? I did times 1.25. The math is income times 5.5 times 1.25, and this gives you your purchase price. And yeah, that's correct. From a $400,000 purchase to a $687,500 purchase on the same $100,000 income, just because you were able to get a 20% down payment and avoid the stricter CMHC rules. Let me recap and warn you yet again. The recap first. If you're buying with 5% down payment, multiply your admissible income by 4. That's your purchase price. If you're buying with 20% down payment, first multiply your income by 5.5 to get your maximum loan, then by 1.25 to get your house price. Simple. Now the warnings. These numbers work only with today's rates. In April 2024, the multiples will change as time goes by, and as the rates drop, that multiple will rise. This means that as your loans get cheaper, you'll be able to afford bigger and bigger homes. Which brings us finally to the news I told you about at the start. OFSI's new loan-to-income rules. Well, first of all, what's OFSI? Well, this is the Office of the Superintendent of Financial Institutions in Canada, the boss of banks in other words. And they just announced a new rule concerning the LTI ratio, the loan-to-income ratio that we've been looking at in this video. Basically, they're going to start limiting a bank's ability to issue loans with an LTI ratio over 4.5. Well, how does this impact you, the borrower? It's not immediately clear because the rule doesn't apply at the consumer level. There will not be an additional borrower test done as a result of this rule. Instead, OFSI will essentially audit all the banks and decide based on their exposure to risk just how many high LTI loans they're allowed to issue. And if they hit quota and you come in too late wanting that big mansion, it might get harder to get it. Now, I know it's a lot of stuff to know, and that's one of the reasons it's important to deal with mortgage brokers instead of going straight to your bank. Stuff is changing all the time on the market, and it pays to stay informed. And that's it. That's all you really need to know about figuring out your own borrowing capacity and what the LTI ratio is. For more videos like this, tune in next time.